A trailing stop is a dynamic risk management tool designed to protect gains while allowing a trade to remain open as long as the price moves in a favorable direction. Unlike a standard stop loss, which remains fixed at a specific price, a trailing stop automatically adjusts as the market price climbs for long positions or falls for short positions. How it functions. The trailing stop is set at a specific distance from the current market price, defined either as a percentage or a fixed dollar amount. Upward movement. If the price rises, the trailing stop follows it, maintaining the preset distance. Price stagnation. If the price stays flat, the trailing stop remains at its last highest point. Price reversal. If the price drops, the trailing stop stays frozen. If the price hits the stop level, the trade is closed. Common trailing strategies. Traders often use technical markers rather than arbitrary percentages to set their trailing distance. Using moving averages, MAs, as a trailing stop is a popular trend-following technique. Instead of a fixed dollar amount, the exit point is determined by the market's momentum. As long as the price remains on the correct side of the average, the trend is considered intact. 1. Choosing the type of average. The type of moving average you choose dictates how tight or loose the trail will be. Simple moving average, SMA, calculates the average price over a set number of periods. It is slower to react, which helps avoid whipsaws, getting stopped out by minor price spikes, but may give back more profit before exiting. Exponential moving average, EMA, places more weight on recent price action. It follows the price more closely than an SMA, making it better for aggressive trends where you want to lock in gains quickly. 2. Common timeframes and settings. The length of the moving average should match your trading style. Fast, 9 or 20 periods. Used by day traders or for parabolic moves. If a stock is surging vertically, a 9-period EMA acts as a very tight floor. Medium, 50 periods. The standard for swing traders. It filters out daily noise while capturing the meat of a multi-week move. Slow, 200 periods. Used for long-term position trading. If the price falls below the 200-day SMA, it often signals a fundamental change from a bull to a bear market. 3. The two primary exit methods. There are two ways to execute a stop loss using moving averages. A. The touch exit, aggressive. The trade is closed the moment the price touches the moving average. Benefit, maximizes profit retention. Drawback, high risk of being stopped out by a wick during a temporary dip, only to watch the price resume the trend. B. The close exit, conservative. The trade is closed only if a candle closes below, for longs, or above, for shorts, the moving average. Benefit, confirms that the trend has actually broken rather than just experiencing a momentary spike in volatility. Drawback, if a crash candle occurs, the close might be significantly lower than the moving average, leading to a larger than expected loss. 4. Mathematical logic and scripting. In a technical environment, the trailing stop logic follows a simple inequality. For a long position using an N-period EMA, because moving averages can occasionally dip slightly even in an uptrend, some traders use a high watermark logic, ensuring the stop price only moves up and never down, even if the MA flattens. 5. Strategy refinement, the offset. To avoid being stopped out by noise, right at the moving average line, traders often apply an offset or buffer. Percentage offset, setting the stop at 0.5% or 1% below the 2-0 EMA. Volatility offset, using the average true range, ATR. For example, this creates a cushion that expands when the market is volatile and contracts when it is calm. The average true range, ATR trailing stop, is often considered superior to fixed percentage stops because it adapts to the market's breadth. Instead of using an arbitrary number, it measures current volatility to set a stop distance that is mathematically relevant to the specific asset you are trading. 1. The core calculation. The ATR measures the average range of price movement, including gaps, over a set period, usually 14 days. To create a trailing stop, you apply a multiplier to that value. The formula for longs. The formula for shorts. The most common multiplier is 2.0 or 3.0. If the ATR is $2 and your multiplier is 3, your stop will trail $6 behind the price. 2. Why ATR is effective. ATR-based stops solve the problem of one-size-fits-all risk management. Quiet markets. When volatility is low, the ATR shrinks. Your stop tightens, protecting gains in a slow-moving environment. Volatile markets. When price swings become wild, the ATR expands. Your stop widens automatically, preventing you from being stopped out by normal market noise or a temporary spike. 3. Implementation strategies. The chandelier exit, a specific version of the ATR trail developed by Chuck LeBeau. It hangs the stop from the highest high of the trade rather than the current close. Logic. If the price hits a new high, the stop moves up. If the price pulls back, the stop stays flat. It never moves downward for a long position. Goal: to keep you in a major trend for as long as possible until a significant reversal occurs. The ratchet effect. To ensure the stop only moves in your favor, the logic typically uses a highest since entry calculation. Stop equals max. Stop underscore yesterday. Current price minus multiplier times ATR. 4. Choosing your multiplier. Your choice of multiplier defines your R multiple potential and your win rate. Multiplier. Style. Pros. Cons. 1.5 by 2.0x. Tight/scalping. Locks in profit extremely fast. Very prone to whipsaws. 2.5x. Dashes 3.5x. Standard/swing. The sweet spot. Balances noise versus trend. Gives back more profit on a reversal. 4.0x plus. Position trading. Captures massive multi-month trends. Requires a very large initial stop loss. 5. Technical advantages in scripting. When coding an ATR trail, for example in ThinkScript, you can create a switch that flips the stop from above price to below price based on a crossover. This is often referred to as the ATR trend stop. It provides a clear visual line. Green line below price. You are in a bullish trend. Red line above price. You are in a bearish trend. Summary comparison. Feature. Moving average trail. ATR trailing stop. Basis. Price direction/trend. Market volatility. Reaction. Lags behind price action. Reacts to price expansion/contraction. Best for. Strong, smooth trends. Volatile or choppy assets. Using swing highs and lows is a structural trailing stop strategy. Instead of relying on a mathematical average or volatility formula, this method uses the actual stair-step patterns of the market. It is based on the Dow Theory principle. A trend is intact as long as it makes higher highs, HH, and higher lows, HL. 1. The logic of the structural floor. In an uptrend, a swing low represents a point where sellers were exhausted and buyers step back in to push price to a new high. Placing a stop just below a swing low is a bet that if this level breaks, the trend is officially over. For long positions, you move your stop to the most recent higher low. For short positions, you move your stop to the most recent lower high. 2. How to identify a valid swing point. To automate or standardize this, many traders use the bar counting method, often called a fractal or Gann swing. A swing low is defined as a low that is lower than the M bars before it and M bars after it, commonly a 3-bar or 5-bar pattern. Manual identification. Look for V shapes in the price action. The bottom of the V is your new stop level once the price breaks above the previous peak. 3. Step-by-step execution. Long trade. 1. Initial stop. Place the stop below the low of the pattern that triggered your entry. 2. The wait phase. As price moves up, it will eventually pull back. Do not move your stop yet. 3. The confirmation. Once the price turns back up and breaks above the previous local high, the new V-bottom is confirmed as a higher low. 4. The move. Trail your stop to 2 to 5 ticks below that new higher low. 4. Pros and cons. Pros. Cons. Logic-based. You only exit when the market structure actually breaks. Subjectivity. Swing points can look different depending on the chart's zoom level. Wide stops. Naturally gives the trade plenty of room to breathe during normal pullbacks. Delayed protection. You may have to wait a long time for a new swing point to form, leaving profit at risk. Clear targets provides obvious levels where other traders' stops are likely clustered. Liquidity. Large giveback. By the time a swing low is broken, you may have surrendered 20 to 30% of your peak gains. 5. Advanced techniques. The 2-bar rule. Some traders don't wait for a full swing. They trail the stop to the low of the lowest of the last 2 bars. This is a much tighter, momentum-based version of a structural stop. Break-even plus. A common rule is to move the stop to break-even only after the first higher low has been established and the price has cleared the initial entry high. Time frame alignment. You can trail based on swing lows on a higher time frame, e.g., using 15-minute swings for a 2-minute entry to avoid being shaken out by micro-volatility. 6. Combining with ATR. Because market makers often hunt for stops exactly at the swing low, many professional traders use a buffer zone. Greater than stop level equals swing low price minus 0.25 times ATR. This prevents a stop run from kicking you out of the trade just before it continues in your direction. A step-based, or R-multiple trailing stop, is a systematic approach where the stop-loss moves in discrete, predetermined jumps based on the progress of the trade. Unlike a moving average or ATR, which can change every second, a step-based stop only moves when specific performance milestones are hit. This strategy is built around the concept of R, the initial amount of capital risked. 1. The R-multiple framework. In this system, your trail is dictated by the ratio of your current profit to your initial risk, R. Step 1. The break-even move, 1R. Once the trade moves in your favor by the same amount you initially risked, reaching plus 1R, the stop is moved to the entry price. Objective. Eliminate the risk of ruin on the trade as soon as possible. Step 2. Locking in profit, 2R. When the trade reaches a profit of plus 2R, the stop is moved to the plus 1R level. Step 3. Following the trend, 3R plus. As the trade hits plus 3R, the stop moves to plus 2R and so on. 2. Common step configurations. Traders often customize the size of the steps based on the asset's personality. Step type. Logic. Best used for fixed R step stop moves exactly 1R every time price gains 1R. Disciplined, high probability setups. Tightening step move to break even at plus 1R, but move to plus 1.5R at plus 2R. Momentum trades where you want to lock in gains faster. Delayed step. No move until plus 2R, then jump straight to plus 1R. Trades that need a lot of room to develop early on. 3. Pros and cons. The advantages. Psychological ease. It removes the stress of guessing where the stop should go. The math tells you exactly when to move it. Fixed reward to risk. It ensures that if a trade reaches a high R multiple, you are guaranteed to walk away with a significant portion of that R. Ease of automation. This is one of the simplest strategies to script into a trading platform, e.g., using a trigger price and new stop logic. The risks. The give-back gap. If a trade reaches plus 1.9R and then reverses, your stop is still at break-even. You give back nearly 2R of open profit because the next step wasn't triggered. Arbitrary levels. Unlike swing highs/lows, these steps aren't based on market structure, so the market doesn't know or respect your plus 1R level. 4. Technical logic for scripting. If you are building this into a watch list or a strategy, the logic looks like a series of if-then gates. For a long position with an entry of $100 and a $2 risk, initial stop $98. IF price GE $102 plus 1R, set stop equals $100. IF price GE $104 plus 2R, set stop equals $102. IF price GE $106 plus 3R, set stop equals $104. 5. Strategy refinement, the parabolic step. Some traders use a diminishing step to capture the end of a blow-off top. Early in the trade, the steps are wide, moving every 1R. As the trade extends to plus 4R or plus 5R, the steps become smaller, moving every 0.5R. This effectively squeezes the trade as it becomes overextended, ensuring you exit near the peak of a vertical move. Comparison of step-based versus others. Moving average ATR, continuous and curvy. The stop changes with every candle. Step-based, staircased. The stop remains flat for long periods until a specific threshold is crossed. Pros and cons. The advantages: locks in profit. It ensures that a winning trade doesn't turn into a losing one if the market suddenly turns. Removes emotion. The exit is automated, preventing the urge to hold on just a bit longer during a reversal. Flexibility. It allows for unlimited upside in a trending market. The risks: market noise. If the trail is too tight, a minor pullback or normal market fluctuation can trigger the stop and kick you out of a trade that eventually goes much higher. Gap risk. In volatile markets or overnight sessions, the price can gap past your trailing stop, meaning you might be filled at a worse price than intended. Technical implementation. Example: in many trading platforms, you can script these exits. For instance, a basic logic for a long position might look like this: if current price minus trailing amount greater than current stop level, then new stop level equals current price minus trailing amount, else new stop level equals current stop level.